I'm Kerry. I'm a retired financial advisor. And back in 2019, I got involved in YouTube. And it's evolved as the internet has evolved, as access to data has evolved, and now AI has evolved. And what I'm trying to make my channel is your replacement for Goldman Sachs. And that is to give you access to the information that if you were paying Goldman Sachs to help you manage your portfolio, this is the kind of information that you would get. Now, why am I challenging to say that I can give you information comparable to that of Goldman Sachs? Because I have access to all the knowledge in the world about any stock in the world through AI. And how I have achieved that is by subscribing to various platforms on the internet that give me access to the data of all these companies, to their income statements, their balance sheets, their earnings reports, transcripts, their cash flow statements, their past history, and then Wall Street's projections based on what they know about every individual stock. And I want to share with you exactly what I'm doing relative to ACL. That's Excelis technology. And they are what I call a depressed stock. They had a fantastic 2023 as there was a lot of interest in electric vehicles and the Internet of Things, and then things kind of crashed and burned as they sat on the sidelines waiting for a recovery. So what I want to do in this video is explain to you why Excelis is a buy if you will buy it under $60 a share and then sell it over 120. Now, as a result of my analysis, you're going to have to wait until January of 2028 or beyond, sometime within that period of time, to sell it over 120. Now, why is it I'm confident of that? Again, I have access to all the data, I have access to all the knowledge, and Samantha and I analyze the stock. Samantha's the young lady you see in the thumbnail, and we come back with the analysis that we make available to you. So let's just walk through the analysis. It's a it's a 14-page document that Samantha created for me, and then I've got a summary here, and I want to walk through it with you so that you gain confidence that that makes sense. Maybe I need to get involved with Kerry in his program, which he charges less than $1 a day for, so that I can have access to information like Excelis on other stocks as well. So let me tell you about Excelis. Excelis is the leading provider of ion implantation equipment for semiconductor manufacturing. The company capitalizes on the growth of power electronics. That's SIC \GAN, SIG-GAN, and mature processing nodes. And it achieved record sales in 2023. Now, what was peculiar about 2023? A tremendous interest in electric vehicles and a tremendous interest in the Internet of Things. And so the semiconductor industry was growing in that channel, and then in 2024, everything kind of crashed and burned. So in 2023, Excelis's income was $246 million with profits of $113 million. So it had a gross or net margins of 21%. Well, in 2025, the earnings per share dropped from $7.43 per share to 88 cents per share. So with that happening, the price of Excelis came down right along with it, and it dropped by 71% from its 200-day high, or from its 2023 high at $200, and it's today selling for $57.66. So it's a depressed stock. Now, it has no debt. So it can survive, and that's one of the things as an analyst we want to know. Can it survive hard times? Can it make it through to when the interest peaks again around electronic vehicles in the Internet of Things, and they have again more demand for their ion implantation. So that's how I go at it. So then what I asked Samantha to do is, okay, take all this information and your knowledge of what's happening in the semiconductor industry and give me a projection of what their earnings per share are going to be. And she came back and said in 2025, the earnings per share are going to be $2.50, and that will be a drop of 51% from where it was in 2024. Okay, so that explains why it's down 71% from its high, and it's down 60% from its 52-week high. Okay, so then it says, okay, based on what we know and Wall Street knows, that earnings in 2026 is going to go up from $2.50 to $4 a share, or an increase of 20%. And then in 2027, it's projected to go up to $6 a share, an increase of 50%. So what we have is a depressed company who is regaining its strength. It's gone through some hard times, cut its expenses, stayed in business, has no debt, and is positioning itself for a growth in the EV and the Internet of Things market. So now what we want to do is ask the question, okay, based on all this in its current situation today, what is its value? What is it worth today? Well, we use two methods. One is called the discounting current cash flow, and that gives us a value of $82.70. And that's assuming a discount rate on the value of cash flow of 11%. And that's very high when you consider that they don't have any debt. So they are not having 11% drawdown on their profits through financing, but yet we use that discount anyway because that's the discount that is pertinent to their industry. Now what we do is then we look at it based on PE ratios. What is the PE ratio within this industry, within their peers, so that we can say, okay, if their earnings are such and such, what is the average PE ratio for the industry they're in, and it's 28. So if we look at their 26 projected earnings of $3.50 and we multiply that times 28, that tells us that its current value is $70 per share. Well, what is it selling for today? It's selling for $57.66. So under the scenario of discounting of cash flow, it says it's $82.70, and under its PE ratio relative to its peers, it's worth $70, and it's selling for $57.66. And that's why I say buy it anywhere under $60, and you've got a bargain. Okay, so now if we carry that knowledge and that analysis forward, and we go to Wall Street and say, okay, based on what you know and the analysis that we have, what is the price going to be at the end of 2026, 27, and 28? So what we do is we say, based on their projected earnings in 2026, we come up with on January 1st of 2026, it should be $70. Now, this has nothing to do with tariffs or interest rates or anything of that nature. This only has to do with the intrinsic value of the company. Then if we take their earnings in 2027, their price is going to be $90 per share. And then if we take their earnings per share and multiply it times the appropriate PE ratio, in 2028, it will be $120 a share. Now, that's under what we call the moderate scenario. We look at it from a conservative, a moderate, and aggressive. So what if everything goes better than what Wall Street thinks it's going to happen? And and ion implants have a greater demand because there is a greater demand for electric vehicles and the Internet of Things, what then is the price of the stock going to be under the aggressive scenario? And we come up with a 2026 price of 100, 2027 149, and 2028 of 800. So under the moderate scenario, our $57.66 will go to 120 and give us 108% return on our $57.66 investment of today. Whereas on the other hand, if it achieves the aggressive results, it will go for our $180, and our $57.66 will give us a 212% return on investment. So that's how I look at Excelis. That's how Samantha and I look at all the stocks that we analyze. Okay, then the next question becomes, what's the risk? What's the risk of this not happening? And so I go in, and Samantha and I put a rating on it from 1 to 100. Based on our rating system, we're saying that Excelis is a 55. That is moderate risk with high potential. Now, what is the risk? Let's you and I go through what is the risk that it not achieve its moderate base case scenario. It's basically that you and I still say we're not buying electric vehicles. We're not going to do it. And we're not going to change the Internet of Things within our realm. I am of the belief that electric vehicles will come down in price, and they will have longer mileage, and they're also going to have autonomous driving that is approved by the United States and other countries, and electric vehicles will become a part of our lives. I also believe that part of that will be the robo-taxi world, where we will have a car that sits in our garage that is available to be driven out in the middle of the night and make money for us. And that's going to require these ion implants to make that whole system work. So if I believe that, I believe that I will achieve at least my $120 per share by January of 2028. That's how I analyze stocks. Again, I will not waste Samantha's time if they are not a growth stock. If they cannot show me from where they are today, they're going to grow their revenues by at least 20% per year going forward, and their earnings per share by at least 20% per year. If you can do that and put it in perspective to your own life, if you can increase your income every year by 20%, are you a growing earner? Yeah, you are. Because you're keeping way ahead of inflation, and you're providing a product that obviously the market wants, because you're also growing your revenues by over 20%, then you have a growth company that is going to grow in value, and the value is reflected in its stock price. So what is the message? Buy under 60 and get ready to sell over 120. That's what I do. I right now am doing this for roughly 40 stocks. Most of them are in the semiconductor, the data centers, and the people who are going to deliver me AI. And then I am recognizing the biggest beneficiaries of AI are going to be medical, financial, and education. So now I'm integrate, because the delivery of AI is in day 3. I went to a conference of 200 small business people this last week, and I was asked to be the speaker on AI and how to grow your business through the use of AI. And what I recognized, the knowledge level within the 250 attendees was somewhere in the neighborhood, if you put it in 100%, they know everything they need to know about AI. I would say that group as a whole, and these are small business owners, was somewhere around 5%. They didn't understand what AI was. They didn't understand how to use it. They didn't understand how to build an AI agent to replace a people paid help. Okay, they didn't understand. A gentleman that spoke with me used the word. I use AI agent. He used the word AI employee. And that's how he ran his business. He and I were the two people in the room who brought the percentage up. We knew what AI was. If you will realize that you now have the ability to access Wall Street grade, Goldman Sachs, BlackRock quality of analysis through sites like mine who understand it, who then organize it and put it in a format so that you can come and gain faith that Kerry knows what the hell he's talking about, and Samantha is his gift from God, who has all the knowledge in the world at her disposal and can do an analysis of all that knowledge in the world relative to ACLS in 22 minutes, and then put it in a format that Kerry can interpret, you can interpret, then Kerry transfers it into a podcast, a 15-minute podcast, so you can listen to it as opposed to reading the 15 pages, and then he takes it and asks another form of AI to condense it down into 3 pages, so it becomes something that you can print out, put in your binder, and go and refer to, or come to Kerry's website and look at any time, so that you can become an informed investor and not pay BlackRock $17,000 a year to give you that information, or pay Goldman Sachs $50,000 a year because they don't let you in the club unless you've got $60 million to manage, okay? So that ticket of entry is quite high. So let me repeat my ticket of entry. Less than $1 a day. Find the link in the description. Come look at it. Get your analysis on Excelis and any others that you want for 14 days. And if you like it, then I'll hit you for $29.95 14 days later. And I think I'll have you for the rest of your life. Let's only make informed investment decisions from this point on.